Thinking of buying a home? Let's get you ready for successful home ownership. First thing is starting a budget. You need to first see how much money you have left over at the end of every month after paying all your current obligations. Then you need to calculate how much you're currently paying for your rent or mortgage and how much more you can comfortably add in from the monies you have left over at the end of every month. And start saving this amount. Let's set up a hypothetical situation. Say you think you can pay $3,000 a month for your new home, but you're currently paying $2,000 a month. On the first of each month, go ahead and pay your $2,000 and simultaneously bank $1,000, and do not touch this account that this money is going into. After doing this for a few months, you will know how comfortably you can live with the assumption of a $3,000 mortgage payment. This will mentally and financially start getting you ready for a higher payment when you purchase your home. Most likely, your new house payment will be higher if you're currently renting. I'm suggesting you do this so that the purchase of your new home is a pleasant experience. So often, buyers have remorse after closing on their dream home because they were not mentally ready for the sacrifices they need to make to afford the higher payment. Let's admit, dream buying is fun and buying a home is incredibly exciting, but you must be mentally ready and financially ready for this payment. Here's where reality sets in. A lender may say you qualify for a $5,000 monthly house payment, but do you want a $5,000 house payment? When a lender qualifies you for a loan, they don't take into consideration your cell phone bills, daycare, cable TV, internet, car insurance, life insurance, health insurance, gas, tolls, or even groceries. After a lender tells you how much you qualify for, you still need to add back in all these expenses and see if you really want to take on a mortgage of that size. After living within your hypothetical budget, you will know what a comfortable monthly payment is to you and your family and what sacrifices you and your family are willing to make for that higher house payment. A monthly mortgage payment consists of principal, interest, taxes, insurance, HOA fees, and if you put less than 20% down, you may also have to pay what's called a private mortgage insurance fee. Although you may have a fixed interest rate, the principal and the interest will remain the same for the life of the loan. However, you will see flexibilities in the property taxes, insurance, and the HOA fees. These flexibilities will cause that monthly payment to either increase or decrease, most likely increase. Also know with a larger home come larger expenses, and you may now have a lawn and pool to maintain, and please allow for annual increases on those mortgage payments. Be very realistic with your budget. If you're currently renting and thinking of purchasing a home, don't wait till your lease is getting ready to expire. I would suggest you start getting your financial situation in order as soon as you know you want to purchase a home. This may be the day after you renew your lease. You still may be a year out from purchasing, but it's never too early to start getting ready. Committing to purchasing a home early gives you clear vision of what you need to do and time for everything to come together. Hopefully you use this waiting time to pay down some debt, not buy big ticket items like a boat or a car. Hold off on that cruise till after closing. Save money and work on improving your credit score. Refinance some debt to lower the monthly payments, and so on. Start saving money early. Here are the main costs to consider when saving for a house. Down payment. Your down payment requirement depends on the type of mortgage you qualify for. Some conventional loans aimed at first-time home buyers with excellent credit score require as little as 3% down. But even a small down payment can be a challenge to save for. 3% down payment on a $550,000 home is $16,500. A family member can gift you this money, but the amount they can give you is capped, depending on the mortgage program you qualify for. A lender will match you to a mortgage program and tell you how much of a gift you can accept. VA buyers only need money for closing costs. In a buyer's market, we can ask the seller to pay most, if not all, of your closing costs so that you can get into a home with zero money out of pocket. Closing costs is another expense. These are the fees you pay to finalize your mortgage. If you're making a 3% down payment on a $550,000 home, your closing costs and prepaids will be around $12,000. That's money you will have to pay in addition to your down payment. In a buyer's market, we can most often ask a seller to pay a portion of these closing costs. If you purchase a new home, builders will pay a portion, if not all, of your closing costs. And let's not forget move-in expenses. You'll need some cash after the home purchase. Set some money aside for potential immediate home repairs, upgrades, furnishings, and moving expenses. Now let me give you an idea as to how to save some money for your home purchase. I would suggest you sit and look at all your banking and credit card statements for the last 3 months. I say 3 months because there may be services you only pay for every quarter. This will give you an accurate picture as to where your money is going. Now go through each line and start looking for items you can go without or cut back on. Your spending consists on both fixed and variable expenses. Fixed expenses are car payments, insurance, loans, your current house payment. You will have more flexibilities to cut back on your variable expenses. Perhaps you don't need more than one streaming service. Cut back on subscriptions. Pack your lunch, you'll be healthier for it. Don't have dinner out so often. When you go to the grocery store, make a list and stick to it. If you're getting your nails done professionally, perhaps reduce the number of times you get them done or start doing them yourself. Cancel Spotify, Pandora. Instead of going out for ice cream, perhaps buy a tub at the supermarket and have it at home. You may have to make sacrifices and brutal adjustments until you purchase your home. After closing, you can start splurging again, and please do not co-sign for anyone. Now I'm going to give you ideas as to how to check and strengthen your credit score. Your credit score will determine whether you qualify for a mortgage and the interest rate the lender offers you. Having a higher score will generally get you a lower interest rate, which will determine what your mortgage payments will be. So take these steps to strengthen your credit score. Make sure all your credit cards are paid on time and keep the balances under 30% of the approved line of credit. Do not close any credit cards until you speak with the lender, as this will lower your credit score. Closing credit card reduces the amount of available credit you have and can send your credit utilization up, killing your credit score. If you have credit cards you don't use, occasionally make a small purchase, perhaps a tank of gas, and promptly pay it off. This keeps the issuer from closing this account. Pay all your bills on time. The 5 items that make up your credit score are credit history, credit utilization, new credit, length of credit, and mixed credit. Payment history is the biggest of all factors that affect your credit score. I suggest you put payments on auto pay so you're never late with payments again. Many times it's not that we don't have the money, it's that we overlook the bill. But if you don't like that idea, try this. On the 1st of the month, pay all the bills due from the 1st through the 15th of the month. On the 15th, pay all the bills due from the 15th through the end of the month. If you get into the habit of doing this, you'll never be late with the bill again. Set a reminder on your cell phone for these 2 dates. Maintain low credit card balances. Experts recommend you use no more than 30% of the approved line of credit, and much lower is better. Let me give you an example what this looks like. If you have a $5,000 credit limit on any one credit card, your outstanding balance should never be more than $1,500. How much of available credit you're currently using is called credit utilization, and it's the second biggest factor in your credit score. If your credit score does not qualify you for a great interest rate or the type of mortgage you prefer, it might make sense to put off home buying for a while and use this time to build your credit profile. Here's how. I recommend this for everyone, whether you're ready to purchase or putting off your purchase. This will only help everyone. Get free copies of your credit reports for each of the 3 bureaus: Equifax, Experian, and TransUnion. Dispute any errors that could hurt your credit score, and check all 3 reports for errors. Through the end of 2023, you're entitled to a free weekly credit report from all 3 of these bureaus. This will not lower your credit score, and there is no cost to dispute any errors. and you can dispute as many items as you like. Filing a dispute does not hurt your credit score. I'll add a link below to each of the credit reporting agencies that will show you how and where to dispute errors. The official website authorized by federal law to get your annual credit report is called annualcreditreport.com. However, before you start entering personal information, make sure the site looks just like this one here. Some sites have similar names. This site provides data from all 3 major credit bureaus and extensive history of your credit use, but not your credit score. I will add another link where you can get your free credit score. You're going to print these reports, highlight all that is reporting negatively, and either start making payments on these accounts, dispute these accounts, or have them removed if you already paid them off. Read your reports and start fixing errors. Look for accounts that are not yours, accounts that you have not authorized. If you find errors, dispute them. There are 3 ways to file a dispute online. Call them, but the best way is to dispute it via mail. I would suggest you mail a certified return receipt letter. This is proof that it was received and when it was received. It does not matter which way you file your dispute. Credit bureaus have 30 days, sometimes 45 days, depending on the case's complexity, to investigate, and 5 days to notify you about their findings. Once their investigation is completed, the credit bureaus will respond by mail. The credit bureaus offer a downloadable dispute form that you should print, complete, and include with your letter and enclosures. Enclosures could be proof of something that's been paid for already. Mailing your letter and completed dispute form will help ensure that you give the credit bureaus a clear understanding of your dispute. The credit bureaus will investigate and must remove information they can't verify, but if it's validated, it will remain on your credit report. There may be small differences amongst your reports because some creditors don't report your activity to all 3 bureaus. But if negative information has popped up on one report, it's wise to see whether it's also on the other 2 reports. These are the items I would suggest you dispute: identity theft, payment mistakenly reported late when it was paid on time, inaccurate credit limits on your loan balances, accounts you don't recognize, and addresses you've never lived at. Small errors don't affect your credit score, like a misspelled former employer name or outdated phone number. These are not worth disputing. And sometimes negative marks might surprise you, but it's not an error. If it's accurate, don't use the dispute process. Instead, try to resolve it directly with the creditor. For example, if you accidentally missed a payment, contact the creditor, arrange to pay it, and ask if they will rescind the delinquency so it no longer appears on your report. The credit agencies are not obligated to investigate frivolous claims. Monitor your credit regularly. Monitoring your score and report can tip you off to problems such as overlooked payments or identity theft. It also lets you track progress on building your credit. Most credit cards offer this service at no charge. The following are considerations lenders look at for your mortgage approval. Lenders look at your entire financial scenario. First, they will ask how much money you have for the purchase of your home. If you don't have enough for your down payment, they will not pull your credit report. Your down payment can come from savings, 401k, the sale of stocks or bonds, a gift, or a home you sold, and so on. If you have the money you need for your down payment, then they will go on to ask about your income and employment history. Here they ask all about your income. Lenders only need a 2-year work history, and it does not need to be 2 consecutive years, nor with the same employer. Even if you had a gap in employment, you may still qualify for a loan. Income can be from a full-time job, a part-time job, child support, pensions, VA disability, Social Security disability, or any other type of income a lender can verify. If you are an hourly or commission employee, the lender will average out the last 2 years worth of income. They also look to see if your income has increased or decreased the second year of employment, and if it has increased, that's a good thing. But if it has decreased, that's a problem. My suggestion to you, if you're an hourly employee, is to work as many hours as you can. The lender may not give you credit for all the overtime you're putting in if it's not established. They look for history of overtime work pay. But even if the lender does not give you credit for that overtime money you've earned, you can always apply that money towards your closing costs, moving expenses, down payment. Either way, you're going to benefit from that overtime pay. Another key factor is debt to income ratio. This calculation lets the lender know if you can handle taking on additional debt. Debt to income ratio compares all your monthly loan amounts to the pre-tax or gross income you earn each month. The lower the better. Ideally, your debt to income ratio should not be higher than 36% to qualify you for the best mortgage option. The lender will explain this to you in great detail. Also, but not necessary, lenders like to see monies left over in your account after closing. This money is called reserve. Not depleting all your savings lets the lender know you can continue making the mortgage payments should your car break down or should you have any other kind of emergency. It's only after a lender feels comfortable with all these answers that they will pull your credit. They figure, why pull your credit score if you're not ready to purchase? Any lender who wants to pull your credit report without first asking about your down payment, work history, and income is not a lender you want to use. Keep in mind, each time a lender pulls your credit report, your credit score decreases. After the lender has all this information to work with, they will match you to a loan that works for you. You want to work with a realtor and a lender who will educate and empower you. Purchasing and financing a home is very detailed, and you should understand the entire process. And if you don't understand the entire process, it's because someone is not explaining it to you properly.